We are live for another Quick Tip Tuesday, each and every Tuesday, 8 p.m. Eastern Time. Today's topic is QM versus non-QM loans. What is a QM? A QM is a qualified mortgage. So basically what a QM exactly means is the likely of a borrower to repay the loan, as it meets all the requirements of the Dodd-Frank Act. So the Dodd-Frank Act was passed in 2008 after the crash. There was a lot of guidelines in place to avoid that from basically happening again. So the number one thing from the Dodd-Frank Act is the ability to repay your loan. So that's the most important thing, basically, to avoid that big crash from 2008. They passed this huge thing, the Dodd-Frank Act, which revolves around the ability to pay your loan. So they have the debt-to-income ratios. They have specific guidelines to ensure that a borrower will be able to repay the loan. So your qualified mortgages, which is your QM loans, they fall under your FHAs, your conventional loans, your basically all government loans, Fannie and Freddie, those conventional VA loans, USDA loans. So those fall under your QM loans. When it comes to the non-QM, those are non-qualified mortgages. That basically means they don't follow those rules. Those fall under the non-agencies. So basically there is private investors' money. It's not government, it's not government backed, it's not it doesn't fall under those categories. So those fall under different categories. So private investors, and they basically own rules. One perfect example for non-QM loans is a bank statement loan. So the main reason people go for non-QM, because a lot of self-employed people, they prefer the non-QM route because the non-QM doesn't necessarily look at your tax returns. For a lot of self-employed borrowers, we have a very, very high gross, then you have a lot of expenses, and then your actual profit is what the bank will look at, the qualified mortgage side will look at, then your profit is very low. But if we look at your bank statement loan, we'll see how much money you really have coming in. That calculates your income, and they don't necessarily look at your tax return. So that's one of the huge benefits on that side. What else? We have a lot of other reasons. There's certain limitations in certain areas where FHA doesn't borrow. So they have a specific limit on what they borrow, so which is called the conforming limits. So in certain areas, depending on the price point, FHA may borrow to a certain amount, and you basically have to come up with the difference. So that's another reason someone may go to the non-QM route. There's a lot of other reasons as well. Credit, maybe so, but for the non-QM route, there isn't a low down payment such as for the FHA. There isn't a low 3.5% down on the non-QM side. Typically, you have to put more down. You can go on your primary residence and investment property. What else do we have? So depending on the investor, on who's lending the money, I've seen as low as maybe 10%. Have I seen lower? It all depends on the investor. They can get aggressive, but definitely keep in mind rates may go higher. With the rates rising, I don't want to give a specific percentage out, but you will typically pay, I would say, 1 to 2% more, maybe even more, but that's average, 1 to 2% on the non-QM side. But there's many advantages on the non-QM side. There's actually been a flux and increase of more non-QM loans where people are getting more familiar with it. Let's see, you can get condos that are non-warrantable. So specific condos, to be financed by Fannie and Freddie, they have to be warrantable, basically meaning they have to follow their specific guidelines. And if they don't, Fannie and Freddie, you won't be able to get a conventional loan. But you can go on the non-QM side and actually get a loan for that specific house. What's the average down? So the average down payment, it can vary. You can probably, primary residence, I'll probably say about 10%. Maybe you can definitely go higher. And on the investment side, probably 15-20%. But of course, if you have that relationship with the investor, with the private investors, then the money on the non-QM side, you can probably get a little lower percentage-wise to like a 10%. So that's something to keep in mind as well. Let me see. I mentioned something that I wanted to touch base on. Yeah, for the non-QM, they actually have, I've seen a program for owner occupied. If you have a lot of months of reserves, very cash heavy, and have the down payment of the 15-20% down, they don't even look at you. You don't even have a debt to income ratio. They don't see your ability to repay. So basically, the Dodd-Frank was huge on the ability to repay the loan. What's your debt? What's your income? They calculate debt to income ratio. Do you have money left over to pay that loan off? Then that's how you qualify. On the non-QM side is a little different. So I've seen loans that be very, very cash heavy. I'm not sure exactly how many months of reserves, but I've seen that if you have good credit and you have a lot of cash, they would allow the actual you to qualify for that specific loan. Of course, keep in mind rates are a little higher. So if you're currently having issues trying to qualify for a loan, explore the non-QM options. But I would definitely recommend it if you're more on the self-employed side. If you're W-2 income, have good credit, I would definitely go the regular QM side. But if you're having issues getting qualified on that end, then explore the non-QM world. I just want to touch base a little bit on it. There's a lot of option on that side, specifically for investment properties. There's specific loans that look at what is called the DSCR, which is your debt service coverage. Basically, is the money coming in taking care of the mortgage. There's a certain percentage that has to be above it, and you can qualify for that loan if you have a down payment. What's considered a good credit? It depends on the actual private investor. So I've seen as low as 550, 580, 600, 620, but it just depends on the investor. If you have more reserves and more down payment, they'll probably will be able to go lower on the credit side. I definitely want to keep this short and sweet, but if you want more details of the non-QM side, please do not hesitate to reach out. It's pretty amazing what you could do on that side, but just keep in mind, higher rate, possibly more down payment, maybe need to have more reserves, but it's you more likely be able to close that loan if you don't qualify on the qualified mortgage side. All right.